Hello, welcome to my channel today. This is the King's Tutor. Okay, if you're just joining us for the first time, kindly subscribe to our YouTube channel. Click on the subscribe button and also on the notification bell. Okay, like, comment, and share this video. Okay, now today we want to look at bank reconciliation statement. The bank reconciliation statement is one of the most asked questions or topic in accounting. Okay. So today we want to look at the part A, which is probably the introduction, what it means. Now before we proceed, let's have an overview of bank reconciliation statement. Now, a businessman that transacts business would want to have accounts with the bank, okay, in order to ensure that his financial transaction is effective, okay. So he has his own personal, he prepares his own personal account, and also has accounts with the bank. So any transaction that passes through the bank, okay, for instance, if he makes payment or customer makes payment into that account, definitely he's going to record in his own book, and the bank will also take its own record. For instance, the account prepared by this individual is the cash book, okay, and the bank will prepare its own account. Now, if a customer, for instance, pays in money, let's say sales, okay, definitely if he pays in money for sales and the money comes to the bank account of the businessman, the businessman will debit himself or debit the account, debit his cash book, because he's receiving the money as sales, let's say 10,000. And also, the bank account is being credited with the amount on behalf of the businessman, 10,000. That is why whenever an individual receives money in his bank account, the account is being credited. Okay? So in this situation now, the businessman prepares his own personal in the cash book, while the bank prepares his own. So any amount or any transaction, if the customer, the businessman wants to pay any amount, he credits himself, while the bank is also supposed to be debited. But at a certain given period of time, these two is supposed to be the same. It is supposed to be equal, okay? That is, the same balance you have in the cash book is supposed to be the same balance you have in the bank account. Why? Because it is owned by the same individual, and the same transaction he makes here, that is what is supposed to be here, okay? But at a certain given period of time, the balance in the cash book differs with that of the bank. They have discrepancy, they have disagreement. Okay, and there are many causes or there are many reasons why the cash book and the bank statement or the bank account do not balance. But before we move over to that, let's see some terms that are important in this. The first one is what we know as the bank statement. The bank statement. The second one is the cash book, and the third is the bank reconciliation statement. Okay, now what's the bank statement? Now the bank statement is a statement prepared by the bank to show the business transaction between the bank and the customer. Okay, it shows the business relationship, the transactions that involves the businessman and the bank. So whatever transaction made by the bank on behalf of the businessman is recorded there. Okay? If the bank pays money on behalf of the customer, it will be recorded there. So as a business person or even as an individual, you have the right to go to your bank and request for the statement. It will show you every transaction, what came into the account and what went out. Okay? So the bank statement is that book that shows the business transaction between the bank and its customers. Okay? So this is the account that is prepared by the bank on behalf of the businessman. Also, the cash book is used in this situation. The cash book records cash transactions. Okay, it is used by the businessman to record all his cash transactions. We debit the receiver and also credit what he pays out. Okay. Now, there's what we call bank reconciliation statement, which is what we're about to look at now. The bank reconciliation statement is a statement that is prepared to reconcile the disagreement or discrepancy between the cash book and the bank statement. Remember I said that at a given date, the cash book and the bank statement is supposed to what? Balance. They are supposed to have the same what? Equal balance. But at a certain period of time, there are some transactions that the bank might make that the businessman might not be aware as at a given period of time. For instance, if the businessman asks the bank to pay some money, some bills, like a NEPA bills or telephone bills, probably the businessman have forgotten, but the bank are consistent. Once they start paying that money, they might not inform the businessman. So in the bank account, they will have to reduce the money, but the businessman is not aware, so it will not reflect in his what? Cash book. Okay? So in such situation, you will see that the balance in the bank will not be the same with the balance in the what? Cash book. So whenever this happens, when they have discrepancy or disagreement, we have to look for a statement that will reconcile this statement, this disagreement. Okay? An investigation will be done. Why is there difference between the cash book and the bank statement? Now, that statement that reconciles this disagreement is what we call bank reconciliation statement. From the word reconciliation, it means putting in agreement two differences before now. Okay? So the bank reconciliation statement is a statement that is prepared to reconcile the disagreement or the discrepancy between the cash book and the bank statement. Okay? So let's see what are those reasons or what are those things that will ensure that the cash book and the bank statement do not balance. Why are there differences? What causes those differences? We'll explain them one after the other. Now the first one is what we call unpresented check. Unpresented check. Now what is unpresented check? Now we all know check as an unconditional order addressed by one person to another to pay on demand the person that is what the name is there. Okay? For instance, if a businessman buys something on credit from an individual and pays check, and once he pays check, listen, we're going to look at the transaction and why there is difference. Well, once he pays check, what he will do is to credit his account because the money is going out. So he will just write, probably if he buys from buyer, he will write it here, buyer is paid by check, let's say 2,000. You see, he has credited his account. But probably buyer had a function, a party, and did not go to the bank to cash that money, to get that money. So before, probably as at when he received the bank statement, buyer has not gone to the bank. So you see, he has credited buyer, he has given him the check to go to the bank. But buyer has not appeared in the bank. So you see, the amount here will show a lesser balance than the cash and the bank account. Why? Because once you are crediting that money, you are reducing it from your existing balance. But it has not reflected in the bank account. Okay? So it means that the balance in the cash book will show a lesser balance than that of the bank. So that's one of the reasons why there is difference between the cash book and the bank statement. Unpresented check. Another one is uncredited check. Uncredited check. Now, what are uncredited check? Uncredited check are those checks or money that have been received by the businessman, but it has not reflected in the cash in the bank account. For instance, an individual pays in money. Let's say you saw a businessman sold a bill worth, let's say, 5,000. Okay, and they paid by check. So he received the money, 5,000. Let's say from Olu. Okay, now the bank is supposed to be credited to reflect this money. So if the bank is not has not credited the amount to reflect what has been received by the businessman, you'll see that the cash book will show a higher balance than the bank. Why? He received the money. Okay? He received the money is debited. And any amount that comes to the cash book that he received increase his account balance. So the amount here has been increased, but it has not reflected in the bank account. It is supposed to be credited, but it has not reflected. So that is why it is called uncredited check. So you see, the cash book will have a higher balance than the bank. Okay. The next one is what we call dishonored check. Dishonored check. Now, dishonored check, probably why the businessman pays the check to an individual, let's say a day for 5,000, and a day took that check, it is credited because the money is going out to the bank to cash it. Now, the bank, having gone through the check, dishonored the check. What is dishonored the check? It means that the check is not valid. Now, there are many reasons that might make the check to be dishonored. One of it is, one, if the amount in words differs from the amount in figure. Okay? And also, if there is no money in the account, if they have irregular signature. These are different reasons why the check might be dishonored. So if the check is being dishonored, it means that it has not reflected in the bank. The bank account is supposed to be what? Debited with an amount. But it has not reflected. It has only this part has only been credited. So you will see that the cash book will show a lesser balance than the bank account. Why? The amount that was paid was supposed to be debited here to reduce the amount. Okay? But because the check was dishonored, the amount was not reduced. Okay? The next one is what we call standing order. Order is an order given by the businessman to the bank to pay on behalf of the, for instance, like telephone bills, power holding bills, water bills, and all that. Okay, so if the order has been given by the businessman to the bank, so sometimes the businessman might have forgotten, but the bank will be consistent. So once the bank pays in that money, he would debit his account. For instance, let's say telephone bill, it will be debited. So let's say 5,000. But the cash book, the owner have forgotten, or probably at that period he has not remembered, so he has not recorded it. So the amount in the bank account will show a lesser balance with that of the cash book. Why? Because it only reflected here. It has not reflected in the owner's own record. Okay. So another one that can cause difference is the bank charges. Okay. So most times the bank might charge you for all the transactions or some things they help you to do. Or most time your ATM you might see some reduction. So most time the bank might just reduce the money without informing you. Okay, it's only when you collect the bank statement that is when you can check and see that okay, there's some certain amount of money that was removed. Okay, so the bank will do what? Will debit the account for its charges. So it has not reflected there. The owner might not be aware. So it is only here. So the bank charges might be, let's say, 1,000 naira. So it will show a lesser balance than that of the record of the owner. Why? Because he is not yet aware of this charge. Okay. So another one is dividend. Dividend. Now, what is dividend? Dividend is the returns that are paid to the owner of a share. Once you have a share with a company, once they make profit, they pay those that have shares with them dividend. So this businessman might have shares in different companies. So at the end of the year, once the company shares their profits, send dividend to each of their shareholders, they will put accounts there. So it will come here. So probably the individual is not yet aware. So once the dividend comes, money that is coming into the bank account, so it will show what he has because they are not credited. So let's say 20,000. But this okay, and the dividend will be credited to his account. To show a higher balance in his record. Why? Because he read that they have paid the dividend. Okay. So another one is the bank commission. The bank commission is an amount that is deducted by the bank on behalf of probably a sales they made for the customer, for the businessman. Okay, it's most time related to the bank charges. Okay, so the bank commission also it's debited to the bank account because they will reduce it. Let's say 2,000. Okay, because they will reduce the money. But the business owner is not yet aware. So the bank account will be showing a lesser balance than the cash book. Okay. So another one is the credit transfer. The credit transfer. Now the credit transfer is a money paid by a customer directly into the bank of the businessman without notifying the businessman. For instance, the businessman sold on credit to a customer, and the customer promised to pay later. So before that period, he promises to pay. He definitely pay the money to the bank account of the businessman without calling the businessman to be aware. So the amount just came to the bank account. So it is being credited. It's being credited. Let's say 4,000, but it has not reflected in the cash book. So the bank account is showing a higher balance than the cash book. Okay, that's another reason for the difference. Okay, so another one might be, let's put it here 9, errors by the bank. Errors by the bank. So the bank, they are prone to errors. They are human. Okay, so they are prone to mistake and errors. So most time they might want to reduce money from another customer's account, and they reduce it from your own account. So it means that the bank account is debited, but it has not reflected in yours. Why? Because you are not yet aware. So we are not supposed to reduce money from you. Okay. For instance, let's say a customer that his name is let's say Ade and Bade. Okay, Ade and Bade, they look similar, so they might make a mistake of reducing money from Ade instead of Bade. Okay, so when this happens, it's an error from the bank. So we tend to reconcile this error. Okay, another one is undercasting of the receipt side of the cash book, and also overcasting of the payment side of the cash book. Most time, if the receipt side of the cash book is undercasted, that is, the actual amount that it was supposed to be was reduced, definitely it can cause discrepancy. Okay, so these are what we've seen today. We've seen the bank statement, the meaning. We said it's a book that shows the business transaction between the bank and its customer. And also the cash book, we said is a book that records cash transaction on behalf of the customer, the business owner personally. And also the bank reconciliation statement is that statement that reconciles the disagreement or the difference between the cash book and the bank statement. So we've seen the different reasons, some of the reasons why there's difference or discrepancy, disagreement between the cash book and the bank statement. So we said one of it is the unpresented check, uncredited check, dishonored, standing order, bank charges, dividend, bank commission, and credit transfer. Okay, so this is where we'll stop. In the next class, we'll see the format and the method of preparing bank reconciliation statement. We have basically two methods. First one, preparing it directly, and the second one, preparing based on adjustment of the cash book. So in the next video, we're going to see that. Stay tuned. Okay, so if you're just joining us, please kindly like, comment, and share this video. Please do me a favor, in the comment section, just type hashtag bank reconciliation statement, hashtag bank reconciliation statement, so this video goes viral. Okay, we're on Instagram, TikTok, Facebook. Just follow us anywhere of this platform to learn more. Okay, thank you very much. Don't forget to subscribe.